Welcome! Let's dive right into the world of taxes. You know, not all income is created equal in the eyes of the tax man. Today, we're going to break down the two heavyweights of the Indian tax system, the money you make from your hustle versus the money you make from your investments. And trust me, by the end of this, you'll see just how different they really are.
So, imagine this for a second. Your side hustle is finally taking off, making some good money. And at the same time, you decide, hey, I'm going to sell some of those shares I've been holding on to. It all feels like profit, right? Money in your pocket. But the tax authorities, they see two completely different stories here. So let's untangle that.
All right, let's get into it. The Indian tax system basically sees your money falling into two fundamentally different buckets. And knowing which bucket your profit lands in, that is the absolute key to managing your taxes like a pro.
So, on one side, you've got the income from your day-to-day grind, your active business or your profession. And on the other side, that's the profit you make from selling a major asset, maybe some property or stocks. Really, you can think of it as earning versus selling. Let's break down that first category, shall we?
Okay, so this first bucket has a bit of a formal name. It's known as profits and gains from business or profession, or, let's be real, we just call it PGBP. This is basically the engine room of your earnings. So what is PGB, really? Well, it's the money you make from the daily hustle of your business or your profession. This is not passive income we're talking about. This is the direct result of your active work. The tax law actually dedicates a huge chunk, all the way from Section 28 to 44, just to lay out the rules for this type of income.
Let's look at the basic rules of the game here. First off, you're taxed on what you actually earn, not some guess or projection. If you're juggling multiple businesses, all that income gets pulled together into one pot. And here's the wild part. Even income from an illegal business is taxable. Yep, the law wants its cut, no matter how you made the money. Just don't expect to deduct your losses from illegal activities against your legal profits. Nice try, though.
So how is this actually calculated? Well, think of it like this. You start with the bottom line profit from your P&L statement. That's your rough draft. Then you add back any expenses that the tax code says, nope, can't claim that, like personal spending. After that, you get to subtract any legitimate business expenses you might have missed. And what's left? That's your taxable business income.
Now, the good news is you definitely get to lower your taxable income with legitimate business expenses. We're talking about all the usual suspects: rent for your office space, repairs on your equipment, the depreciation on your assets, and even things like contributions to your employees' provident funds. These are all your allowable deductions.
But of course, you can't just deduct everything. The tax office draws a pretty firm line in the sand. You absolutely cannot write off your personal expenses. You can't immediately deduct the entire cost of a huge new machine. That's capital expenditure. And they're also really strict about large cash payments. Anything over 10,000 rupees is usually a no-go. These are definite non-starters.
Okay, so that's the money you make from your daily operations. But what about those big one-off events like selling a major asset? Well, that brings us to our second bucket of profit: capital gains. Now, the definition here is super important. Capital gains happen from the transfer of a capital asset. Notice the specific words. It's not just about selling something, it's about a formal transfer of ownership of a very specific kind of property. And it's all covered under Section 45.
So, what in the world is a capital asset? Well, an easy way to think about it is that it's pretty much any property you own, but with a few key exceptions. So the inventory you keep for your business or your raw materials, no. Most of your personal stuff, like your clothes, also no. But things like jewelry, real estate, and even urban agricultural land, those fall squarely into this category. Okay, and this next part is really important. The law splits capital assets into two types, and it's all based on how long you've held them. For most assets, if you've owned it for 36 months or less, it's considered short-term. For things like shares and securities, that window is much shorter, just 12 months. If you hold on to it for longer than that, congratulations, it becomes a long-term asset. And this matters a lot because long-term gains often get much better tax treatment, really to encourage stable, long-term investing.
The math for this is actually pretty straightforward. You start with the sale price, what they call the full value of consideration. From that, you subtract what it originally cost you to buy it, any money you spent improving it, and any costs you had while selling it. What's left over at the end? That, my friend, is your capital gain. And now for the part everybody loves: how to save on taxes. The law actually provides some really powerful exemptions. But here's the catch. They almost always involve reinvesting your profit in a smart way. Let's see how that works.
This table right here is basically your cheat sheet for the most common exemptions.
And you'll notice a pattern, right? You save tax by taking the money from a sale and putting it into a new asset. For example, Section 54 lets you avoid tax on selling a house if you just go and buy another one. Section 54EC gives you a different route. You can invest your gains in specific government bonds. Each one of these sections is like a unique strategy for your tax planning.
So, what if you sell an asset, like right before the tax deadline? You might not have time to find a new property to invest in. Well, that's where the capital gains account scheme comes in. It's basically a legal safety net. It lets you park your money temporarily so you can still claim the exemption, and it buys you more time to make that final investment. Pretty neat, right?
So, after looking at both sides of the coin, let's bring it all together for one final, crystal clear comparison. What is the fundamental difference here?
Okay, so here's the bottom line. PGB is all about your operational income, the money you make from selling your stock in trade, which is just the goods or services that are part of your everyday business. Capital gains? Totally different ballgame. They focus on the profit from an asset transfer involving a capital asset, something you own, not something you regularly trade. It's the difference between taxing your economic activity and taxing a change in your personal wealth.
Before we wrap this up, there's one last crucial piece of advice. This applies to everything we've talked about, whether you're a student cramming for exams or a professional filing your taxes. This right here is the golden rule. The tax code is built on specifics. Whether you're filing a return or trying to ace an exam question, mentioning the correct section numbers, the exact conditions for a deduction, and the specific financial limits is absolutely critical. The details really, really matter.
So now when you're thinking about your next big financial step, whether that's growing your business or selling an asset, you have the essential framework. You can ask yourself, is this an operational profit or is it a capital gain? Understanding that difference is absolutely fundamental to smart tax planning. So, how are you going to use this knowledge for your next move?